Global debt just hit a record $315 trillion. That's 3 times the size of the entire world economy. It's not just numbers, it's a massive ticking time bomb that could reshape global markets and economic stability. In this video, we're diving into how rising debt is quietly threatening the world and what it means for the next decade. Part 1. The scale of global debt. Let's start with the numbers. According to the Institute of International Finance, global debt reached $315 trillion in early 2025. That includes government debt, corporate debt, household debt. And it's not just the US or China. Every major economy is part of this surge. The global debt-to-GDP ratio is now over 330%. That means for every $1 of real economic output, there's $3.30 of debt riding on top of it. That's not just unsustainable. It's historically dangerous. Part 2. What's driving the debt explosion? There are 4 big drivers behind this global debt boom. 1. COVID-era stimulus. Governments borrowed trillions to keep economies afloat. Those debts didn't disappear. They're still on the books. 2. Higher interest rates. Central banks hiked rates to fight inflation, but that makes it more expensive to service debt. The result? More borrowing just to cover interest. 3. Slowing growth. Many countries are growing too slowly to pay down their debts. Debt servicing is now crowding out investment in education, infrastructure, and innovation. 4. Aging populations. Pensions, healthcare, and social services are ballooning, especially in developed nations. That means more debt to cover demographic-driven costs. Debt isn't inherently bad, but when it grows faster than income, it becomes a drag. And globally, we're at that point. Part 3. Short-term risks to the global economy. So what happens next? In the short term, the risks are very real. Higher default risk in emerging markets. Currency volatility as nations struggle to defend their balance sheets. Slower growth due to debt overhang and tighter fiscal policy. And financial fragility, especially in over-leveraged corporate sectors. Already, countries like Argentina, Pakistan, and Ghana have faced debt crises. But the worry is, who's next? If a major economy falters, like Italy, Japan, or even China, it could spark a global credit event. And with interest payments soaring, even developed nations are running out of fiscal room. Part 4. Long-term impact of massive debt. Loads long-term, the consequences are even more structural. 1. Interest rate. Suppression. High debt levels mean central banks may be forced to keep rates lower than they'd like, just to make debt service sustainable. That leads to artificial asset inflation and distortion of markets. 2. Weaker currency. Confidence. As debt grows, trust in fiat currencies declines. That's one reason why gold, Bitcoin, and hard assets continue to attract interest. 3rd, productivity drag. Debt used to fund unproductive activities, like excessive government consumption, hurts long-term growth. It becomes a dead weight, not a catalyst. 4th, intergenerational burden. Future taxpayers will shoulder the cost of servicing today's debts. That creates political instability and rising inequality. And ultimately, it weakens the global financial architecture itself. Part 5. Who's most at risk? Let's talk geography. Emerging markets are at the highest risk of default. Their debt is often dollar-denominated, meaning if the dollar stays strong, repayment becomes impossible. Europe faces a fiscal squeeze. Countries like Italy and France are spending far more than they collect, and they can't print their own currency. China has a massive shadow debt problem at the local government level. It's opaque, underreported, and growing fast. The U.S.? Its status as the world's reserve currency gives it more room. But even America is seeing deficits near 6% of GDP in peacetime. No one is immune. Some are just more vulnerable and more likely to tip the first domino. Part 6. What's next? Here's what to watch. Debt service ratios. How much of a country's income goes to paying debt. Sovereign credit ratings. Bond yields in riskier markets. And policy choices. Do governments cut spending or inflate it away? One likely path? Financial repression. That means keeping interest rates below inflation, so governments can inflate their debt away while savers lose out. We've seen it before, and it could become the central strategy again. Final thoughts. The world is running on debt, and the fuel is running low. In the short term, high debt makes economies vulnerable to shocks. In the long term, it erodes growth, weakens currencies, and limits policy tools. The solution? More growth, smarter fiscal policy, and the political will to face tough truths. But until then, investors, policymakers, and everyday citizens must navigate a world where the debt load is growing faster than the economy itself. If you found this breakdown helpful, please like and subscribe.